Welcome to the System Simplified podcast, where we feature top leaders who share stories on how to successfully systemize a business. Now, let's get started with the show.
Hello, Adi Klevit here, the host of the System Simplified podcast, where we feature top founders, entrepreneurs, and thought leaders about systematizing a business. And this episode is being brought to you by Business Success Consulting Group, where we create, document, and implement processes and procedures so companies can grow and thrive. And today's guest is Dan Bradbury. Hi, Dan.
Hi, Eddie. How are you?
Good. How are you doing?
I'm doing great. Glad to be here.
Yes, I'm very happy that you are a guest today. Our listeners are here for a treat because, Dan, I'm going to introduce you, but just to give them a little bit of an understanding what we're going to be discussing today. So you are a very successful entrepreneur. You are now an owner of a private equity group that basically helps businesses grow. And you had two successful businesses of your own that you sold successfully. You are definitely very well educated in the area of business, and we're going to talk about that. Like by the age of 20, you read how many business books did you read?
I don't know, but it was many hundreds. I'm in part of my library now, so yeah.
So everything is contained within you, and we're going to talk about some. I have a lot of questions here to ask you about about investing, about growing companies that will really help our listeners understand better how to be better entrepreneurs, and also if they are looking at, an equity group coming and investing in their company, what does it take, etc. We're going to have a very interesting conversation about that. But before we launch into it, I would like to give a big shout out to Topher Morrison, who introduced us. And my episode with Topher was amazing. It was basically about how to create those connections and how to how to be able to pitch correctly to people in different circumstances, whether how to pitch your company and how to pitch basically pitching without pitching, really. And he's an expert at that. And we created a great episode about it, and I'm going to include it in the show notes so people can refer to that.
Yeah, he's an absolute master. You must go back and listen to that episode for sure.
Absolutely. All right, Dan, now about you. So give us a little bit of your story of who you are so our listeners understand who we are talking with.
Well, look, like a lot of entrepreneurs, as a child, I was entrepreneurial, right? I was always trying to do little things and little schemes to make money. And I kind of hated school. So as soon as I was free, I started my own business. And I went hell for leather, and I was really into kind of visualization and The Secret and Tony Robbins, and I really went for my first company. And unfortunately, it was a spectacular failure. And I managed to, in a very short space of time, rack up a monstrously large amount of debt, and over 100 grand's worth of personal debt. And people were recommending that I take bankruptcy. And but I recognized that would only deal with the symptom. As in, it might deal with the fact that I didn't have the money, but the problem was I didn't know how to attract customers. I didn't know how to do good business. And I'm a big fan of Warren Buffett's business partner, Charlie Munger. And one of his favorite quotes, or a quote that I attribute to him, is, if you want to get what you want, you have to deserve what you want. And because the world's not a crazy enough place to reward a whole bunch of undeserving people. And the fact was, Annie, that I wasn't a very good business person. I didn't have the skills and tools that I needed to attract those clients, to maintain the clients, to have the margins that I wanted. So I kind of went on a journey of discovery. But the problem was, I was young and I didn't have any money. And I said, okay, is there a way that I can accelerate it? Again, Charlie Munger often says that everybody's question to him is some version of, how can I be a billionaire like you, only much younger, right? Because the guy's in his late 90s now. And it's like, how can I fast track it? And so for me, I've always been obsessed with learning, and I I said, you know what? Anybody that's been successful in business, the most successful people in the world have either written books or got lots of books written about them. And I said, if I can, the most expensive mistakes are the ones that you have to do yourself, because you might be able to recover the money, but you cannot recover the time. So if I can accelerate that learning process by learning vicariously through other people's mistakes, I can avoid the pitfalls, right? You know, the eighth wonder of the world, so Einstein famously quoted it, is the power of compound interest. So how can I have my wins compound rather than having to go back and start again? So I decided to go meta first and say, you know what, if I could read all these books, I could learn from the best business people and make fewer mistakes, right? I mean, that's why people are listening to this podcast. They're learning from people, and they're not just their victories, but also the mistakes that they made, so they can shortcut the process. You don't get paid more by doing it a longer, more difficult way. So, but the challenge with that is, I imagine a lot of people are listening to me now on 1.5 or 2 times speed, right? Which is hard on some podcasts if you speak quickly like I do, you know. But the beauty with reading is you can learn to read 5, 10, 15 times quicker than you currently do. It's been proven, it's been documented. So I got obsessed with the skill of speed reading, and I got really obsessed with this skill and just practiced. And I thought, how fast is fast? And anyway, I got really into that skill, and I got to some pretty high speeds and accolades. And then I was able to consume hundreds and hundreds and hundreds of business books in a short space of time. And that kind of led me on my entrepreneurial journey. So when I went back, I was able to do it more successfully the second time around. So that's a brief history of the early days. Okay.
So then you had 2 different companies and you sold them, and now you have a private equity group. What made you want to start a private equity group? Like, what's your motivation behind that?
Yeah, I love the game of business. A lot of people listening to this also just love the game of business. And I didn't get it when I was younger. I always thought I'd make X amount of pounds and then I'd be done and that would be it. But everybody that I'd ever met who I knew personally who sold the company says, no, once you become financially free, you'll work harder than you ever have in your life. But it'll come from a different place. And they are absolutely right. After my first kind of 7-figure exit, I was taking some time off with my family in Jamaica. I'd been there about 3 days, and we're by the pool, and my kids are at the pool playing with another family's kids, and the children's mothers are talking to each other, and I end up leaning over and looking at this rather worried guy 2 sunbeds over who was looking deeply concerned, looking at his phone. I said, "Are you okay?" And he said, "No, I'm not." And it turned out he was being sued, and he'd never been sued before. And I quickly got into coaching mode and was helping him and explaining it. Let me read the documentation. And then I realized it's like, look, I'd made the money, and then I ended up doing it for free. Right? Just wanted to help, because I love the game of business. So after my first big exit, I went back with another company, did it again. And then subsequently, I realized, you know what? I don't want to operate the company. All the money's made by the owners. And I actually love the analysis of business, choosing the right winners and putting that capital to work. Because, I mean, you know this, you teach this. All leverage comes from 2 things. It's people and systems. But right. The other source is, of course, money, capital. Leverage can come from capital. So after I got myself into a place where I had the capital, I then put it to work in private equity. So finding the right people, and hopefully they've already got the right systems. If not, I'll send them in your direction, and then ultimately helping them to scale up from 7 to 8 figures and beyond.
Excellent. So let me ask you a question. How do you find the companies that you feel like you want to invest in? Like, what are the different criteria that you look at when you decide to help a company grow?
Yeah, I think there's a few different companies. So there's what criteria I'm looking for, and then how do I find them? Mm-hmm. Now, the criteria they've got to have a proven business model. So they're already established. Then I personally, there's a place for venture capital. I'm not a venture capitalist. I'm not for startup or pre-revenue. I'm for established companies that have got a proven business model. So that normally means they've got seven-figure revenues, right? So that they're not a solopreneur. They're an established business. And really, I personally, again, am not for new technologies. There's a place for that. I'm for people that are already, they're in an industry where there are players that are significantly larger than them. So they might be, I've done quite a lot in the health and fitness space. So somebody can have a few gyms, right? They've got 3 or 4 locations, but they want to get to 30, right? And so they are looking to scale up. So they're established. And specifically what I'm looking for is there's a concept that's proven. There's somebody that can get revenue to a certain point, but then I'm actually looking for what obstacles are in their path that I already know how to solve, because that's where all the value add comes from. The fact is, I'm looking for somebody that is actually a 30 or 40 million pound or dollar entrepreneur. They've just not realized it yet, or they've not figured out there's a choke point, there's an obstacle in their way that I know how to solve. And if I can find that sweet spot where they've got the desire and ambition, right? They've got to want it. But secondly, I think they've got the potential. And just to be clear,
desire and ambition, so it's an established business that
yes,
has a proven business concept.
yes,
There's a potential, because you know that businesses similar to theirs can actually have a potential to grow.
correct.
They have ambition.
Yes.
They have the drive to actually get there, because that's very important, right? So obviously you have good rapport with the owner and you feel like you can help them.
Yes. Yes. A big one, and this is massively overlooked, is I need them to have, I need them to be able to suspend their ego. In other words, they need to be coachable, right? I've achieved quite a few things in my life. It still feels arrogant or egotistical for me to say that, but I'm certain that I do not have all the answers. I think one of the biggest sins is thinking you know what you're doing. And it was Bill Gates that said smart people lulls, success lulls smart people into thinking they know what they're doing. And that is when life is about to punch you in the face, right? You've got to be open to being wrong. And I find the people that are the most you've got to have ambition, but if you're so headstrong, you will not listen to anybody, you're not getting my money. And I would argue you're probably not going to get money from many people, private investors or private equity. You're going to be restricted, because a common misconception, Addy, about private equity is people think, oh, the private equity guys have all the power. That's not true. It's just not true. We might try to protect ourselves legally and with contracts, etc. But the fact is, we're trusting a person, normally the CEO of a company, to utilize our capital to get a significant return. Okay, so that person needs to be on the money. You know, if you look at in the UK, we don't have Shark Tank. We have a show called Dragon's Den, but it's the same concept. If you look at Dragon's Den, they'll always tell you they're backing the person. Yes, the idea needs to be sound, but give me a great idea with the wrong person at the helm, no chance in hell. Whereas if you've got the right entrepreneur who's got that ambition, but they're also open, they're open to coaching, to learning, to being flexible, they will take on board input. Because look, if you just think about it logically, if they already had the answers, if they'd already figured it out, they would have succeeded already. So there must be something that they don't know, because it's cause and effect, and they're not where they want to be because there's something in the way. Okay, so if they're not open to outside input, they are gonna. It's going to be a painful battle to success if they achieve it at all. So humble is the word.
Absolutely, absolutely, I agree with you. Okay, so you have those criteria. So let's talk about that example. I like the example of like, okay, somebody maybe opened a gym or maybe opened 3 gyms, and you know that health and fitness can actually grow to 30, 50 locations more. What are the usual obstacles that you see, or how do you approach that business to actually identify those obstacles?
Yeah, it's a great question. So I after doing this for a number of years, I actually developed I suspect some of your listeners are like this, scorecards. I developed a system. So I don't think it's one size fits all, right? So I found I break it down into 10 separate areas, and I created a scorecard with which I use to analyze a business, and it will score the business in each of these 10 areas. And then each area is scored out of 10, so you've got like 100%. Okay, but so
what are the areas?
Yeah, great. So I'll tell you the list, but the full list or the scorecards is called the Business Profit Maximization Scorecard, and it's on the homepage at danbradbury.com. Okay. But if you don't want to go and take the scorecard yourself at danbradbury.com, in a nutshell, the first one is risk mitigation. Okay, they are looking to understanding the key risks for that business. How aware are they of the risk, and do they have the systems and processes in place to handle those risks? There's it's an alliteration, so they all begin with the letter R. There's reducing expense ratios. Are they dialed in on their numbers? Most business owners are financially illiterate, and it's crazy to me that somebody would go and ask an investor for a large amount of money when they can't read a P&L and a balance sheet. They go, oh, that's all accounting stuff. No, it's not. It's business stuff. It's operational stuff, right? And you've got to deploy that capital to get a return. And I don't need you to know taxes and do tax returns. That is accountant's work. But I need you to be financially smart and understand how to get a return on investment for shareholders. Okay, so you're going to be dialed in terms of reducing expense ratios and understanding margins. You got to get educated. So there's risk mitigation, there's reducing expense ratios, and then I won't list all 10, but just to say it's the opposite of what you think, Addy. So the way that I would say it is, everyone's heard the stats. It's similar in the US to the UK. 80% of businesses fail in the first 5 years. Of the remaining 20%, 8% fail in the next 5 years. Okay, well, in the UK, 94% of businesses never even achieve seven-figure revenue. Not profit, seven-figure revenue. So if you're listening to this and you've got seven-figure revenues, you're already in the elite. But so therefore, logically, if you don't know what to do, just observe the masses and do the exact opposite, and you're more likely to be right statistically. So in terms of a business valuation, there's two primary levers of a business's valuation. One is its profit and one is its multiple, right? What multiple of the profits is the company valued at? And business owners have got a tendency to focus on profit first, but actually it's the multiple. And the multiple is really a measurement. It's a proxy for how reliable, predictable, and sustainable those profits are. And a different way of saying that would be, how low risk is it? Right? How low risk is it? That's risk mitigation. Okay, so once you kind of handle that, then I'll move on over to, driving the profit. Well, there's only two levers that drive profit. They can, and the people thinking right now are going, what are those two levers? Well, logically, one of them is driving revenue. One of them is reducing expenses, right? They're the only two levers, one up, one down. Where does every business owner want to focus? Driving revenue. Okay, I'll tell you the low-hanging fruit is on cost control first. I'm not saying, Addy, don't invest on invest in growing your business. Of course, invest in your business. What I'm saying is, don't be financially negligent and waste money that could be reinvested into the things that are driving you the highest possible return. Okay. So then on the next layer down, and there's four kind of separate layers to the model, but the first layer is about the risk mitigation, the multiple. Then it's about maximizing profits from the expense side. Then when it comes to revenue, you can get new customers or you can keep the customers that you've got. Right. Where does everybody want to focus? Getting new. It's not the low-hanging fruit. It's on keeping the ones you've got. Specifically, how do you retain your existing customers so they purchase again? How do you encourage more repeat purchases? And how do you reactivate past lost customers? Because it's typically quicker, easier, and thus more profitable to do so than going and getting new. I'm not saying we don't go and get new. What I'm saying is, if you're listening to this, you have finite capital and finite time, right? Now, with good systems, you can get leverage on both those elements, but it's still finite. So I want to invest that capital and invest that time in the areas where it's going to get the maximum possible return.
Right. So I want to say on that one, you're all of them, but you're absolutely right on this one. Also, from my experience, it is the gold mine lies in your existing customers, because you already invested the money. If you really calculate how much it costs to get a new customer or client or patient, whatever you are in the business of, it's a lot of money. They already are your customers. Now you want to make sure that you actually make them loyal and they continue to buy, so that it makes the acquisition of a new client much more profitable. So yes, of course, you want to advertise and keep getting more clients, but that's not, you have a whole gold mine there that if you don't have, let's say again, the word systems, if you don't have, it's all about, you have to have a system. Let's take a dentist, for instance, so to acquire a new patient is you're actually losing money, because, you usually have to advertise, you have to give them an offer. Okay, so come and get free cleaning and free x-ray for $99 or $100 or whatever, $200, whatever it is. And then you spend the time with them with the hope that they're going to either give you more work as a dentist because they have dental work to be done, or they're going to be a continuing patient where you can see them every 6 months or 3 months or whenever. But if you just end right there, oh yeah, we got a new patient, but then you don't continue, you're losing so much money. You're leaving money on the table, right? So you have to have a system for scheduling, for scheduling the next appointment, right, for reactivating, for keeping in communication, all of that. So I agree with you 100%. So this is number 3. What's number 4? Oh, sorry, go ahead.
So it's not sexy. So it's just to double down on it. It's not sexy, but it sure as hell makes a lot of damn money. Everybody wants to focus on the sexy thing. Just to take that point and drive it home even further. Yeah. And it's people don't know their numbers. Like, I don't just mean financially. I mean lifetime value to customer acquisition cost. Like, if you've got 2 customers, but you can have the same customer come and buy the same service, or again, a cleaning, like a hygienist appointment. They come and buy that appointment again. Well, then you just got the cost of delivering that service, and the rest is gross profit. Whereas if that person disappears and you have to go and market and get a new one, you've still got the costs of delivering the service, but you've also got the added marketing cost. And so everybody who focuses on the wrong side of the equation, they go, oh, how can I do better marketing to get more customers at a lower cost? I'm not against that. I'm in favor if you can have clever marketing that gets you the right type of customers. But the money, the real leverage is to be made in maximizing the lifetime value. Right? And that's why we go, number 1, risk mitigation. Number 2, reducing expense ratios. Number 3, retention of existing customers. Number 4, driving additional repeat purchases. And number 5, reactivation of past clients that have gone from the flock, and getting them to come back is normally quicker, easier, and thus more profitable than it is to go and acquire a new one. So that's the first 5. I can do the other 5 if you'd like me to.
I'm just curious. So why would you run through them? I just want to know what they are because I'm curious.
All right, fine. And so again, so I'll give you all 10, and then it's all part of the BBM scorecard, and there's 40 questions to get you ranked.
And we're definitely going to include that link there in the show notes, because I would love to encourage all of our listeners to go and take that test. So give me what are the other 5?
Yeah, thank you. Yeah, you don't even need to opt in. You can go and do the test and get a full report. So the danbradbury.com. So they're the first 5. So then once you've got those 5 covered, we now move on to the get side of the equation, getting new revenue. Okay. And when it comes to getting new revenue, you can either get more customers, or you can raise the average order value. And of course, everybody goes, "I'll get me more new customers." But actually, the lower hanging fruit is in raising the average order value, right? That's number 6. So raising the average transaction size. Look, everybody listens to this has heard this before, so I'm not going to belabor the point. McDonald's, do you want fries with that? Okay, it's cliche, but just because it's cliche for a reason, right? Because it's true. And you know what? If you're dialed in on this, you can dismiss this point and move to the next one down on the list. But actually, if you're dismissing this, just you've heard it before, the question is, are you doing it? When was the last time you tested your price point? Right? How do you know that you're optimally priced? Have you tested your upsells? Right? It's astonishing how many are leaving so much on the table. So that's number 6, raising average order value. Then underneath increasing the number of customers, number 7 is ramping the conversion rate, i.e., everybody listening to this, you've got an established business, you've already got a certain number of leads, and a certain number of those leads convert to customers. Let's just pretend it was 10% of leads become customers. Well, there's 90% of the leads aren't purchasing. Okay, unless you've optimized and systemized that follow-up process, I'm telling you right now, there's at least another 10, right? And in experience, if there's no follow-up to a comprehensive, well-tested, systemized follow-up, on balance, I find you can treble it. So you go from 10 to 30, right? Which is going to treble your revenues, which would more than treble your profits, right? If people want to have a look at a much younger, much slimmer version of me, if you go to YouTube and YouTube my name and Ultimate Marketer, so Dan Bradbury Ultimate Marketer, there's a 20-minute video of when I won the Infusionsoft Ultimate Marketer competition back in 2009. And I won a Porsche Cayman as a prize in this kind of international marketing competition. But the 20-minute video is just of a presentation of a business that I had that I scaled. I scaled it massively. I took it from a standing start to over $1 million in revenue in 10 months. And it was purely from testing and systemizing that lead follow-up process right there. So you can dive really deep in that, just in ramping up the conversion rate. Okay, so that's number 7. Number 8.
Then send me the link to the YouTube video. I'll include it in the show notes because I want people to watch that.
Okay, great. Yeah, it's a great little video. I'll make a note. Number 8 is reaching the ideal clients. Look, it blows my mind. Most people say that their products they're the best that there is. But the crazy thing is, people have got a premium service, a first-class service, but they're marketing to economy passengers, right? So like if you think about what attracts, if you think of somebody that's only ever flown first class their whole life, how do they decide which airline to fly with? Normally, it could be a variety of things. It's who's got the most convenient flight, who's got the best airline lounges, who's got, the comfiest lie flat beds, like the whole bunch of criteria. But what it's not typically is price led. Whereas if you think of the economy passenger, I'll say something like Southwest in the US or kind of Ryanair or EasyJet in the UK, like they're people that have gone, we've got the cheapest flight. Now, I want to be clear. Southwest Airlines have made more than any other airline because they've figured out a business model that allows them to operate that way. But the point that I'm making is most small business owners can't do that because you do not have economies of scale. So in order to thrive, we can't compete that way. We need to compete on service and extra added value. But if you think about it, if you're trying to attract those first-class premium clients, the marketing that attracts economy passengers turns off the first class passengers, right? Because it's going for a completely different marketplace, right? I've got friends that will drive 90 minutes past their closest airport to get to a different airport just because the local airport only has the equivalent of Southwest and they refuse to fly with that shitty airline, right? I want to be clear. It's not about it's no judgment on people or wanting to fly economy off. It's not about that. It's about saying, okay, how do we attract the ideal clients. Because most people listening to this, if you think which of your customers have been the biggest pain in the ass across your career, is it the people that have spent the most or spent the least? 80 to 90% of people answer that question by saying, yeah, the customers who spend the least are the biggest pains in the ass. And I kind of go, okay, so why the hell are you marketing to them? Right? And they've often got a very different demographic and psychographic. So what makes them buy is very different than this kind of premium first-class client. So how do you attract more than them? Right? So that's number 8. Number 9 is referral systems. Right, as in, if you look back and you analyze, and I'm a real data freak, Andy. So if you look back and analyze, people that come via referral buy more quickly, they convert at a higher rate, they spend more money, they come back more often, and they're less likely to refund or complain. So they're worth a lot more to you. It's probable, if you're listening to this, a lead that comes via referral is worth 4, 5, 10 times as much as a lead that's come via LinkedIn or Facebook or some cold advertising source.
Absolutely. And you know what? But Dan, to that point, if you actually do the step before and actually get your ideal client, then people refer people that are like them. I mean, the majority, right? I mean, I noticed that.
100%.
You probably noticed that. I mean, somebody that, to your example, somebody that flies first class probably has other friends that flying first class. And if they're happy, they're going to refer somebody who's like them.
100%. Which, and if you think about it, it sounds crazy, but it's true. So then all of a sudden you got people that are spending more money, happily spending more money, and they're buying more easily. And yet most business owners don't try and systemize it. Look, if you're listening to this and you've been in business more than a handful of years, I know you get business via word of mouth, because you can't survive today with social media if your service is terrible. But the thing is, so you're already getting some word of mouth, some referrals. But the question is, do you have a system to measure and maximize those referrals, right? And ask
for referrals, right? I mean, that would be one of them. Prospecting, asking for referrals, rewarding referrals, all of that, right?
100%. I mean, it does vary. The form it takes shape varies depending on the business type and how it's done. Certain things work very differently in different industries, but regardless, yes, at the base level, if people aren't even asking, they're not asking it, they're not measuring it. And if you measure it amongst your team, you'll find that the number of referrals you'll generate will go up and it becomes self-reinforcing. So that's the first.
By the way, I did a great podcast. I want to mention it here with Adi Kalkavachin from G4 Marketing and the Wealthy Contractor. And I'm going to find that episode and put it in the chat, in the show notes, because she and I talked about how to build a great referral system, and she's definitely an expert at that, and I would like people to listen to that as well, because that will give an idea, and I'm sure you have tons of ideas of that as well. But having a referral system, you're absolutely right, is crucial. It's a goldmine as well. I mean, this is like your least expensive way of advertising and marketing.
Right. It's critical. So I'll listen to that episode. I look forward to getting the link. But the thing I want to emphasize is I've just done the first 9, and they are deliberately in that order, i.e. In terms of where I find the highest leverage. So when I analyze a business, looping all the way back to the start, when I analyze a business, or with this scorecard, the BBM scorecard, I'll analyze a business and I find the highest leverage. I'll start with risk mitigation, reducing expense ratios, retention of existing clients. That's a good defense for the business. Get that first. And then I move on to develop, which is the next 4. Repeat purchases, reactivation. And I work down the list. And then finally, the more disruptive tactics are at the end. So you might need to pivot and get the ideal clients. Okay. But sometimes pivoting that takes change of branding and marketing and positioning, and that can take time. So it's not without risk. So it needs to be considered. And then number 10 has made me more money than the first 9 combined. It's made me many, many millions of pounds personally, but it's also cost me many millions of pounds. I want to really caveat this up front, Ali, because it's high reward, but it's also high risk. And so number 10, the 10th R is roll-ups. And roll-ups is a mergers and acquisitions term. So in other words, if you put 2 similar companies together, often you get cost synergies and revenue synergies, right? So if you've got two gyms and you put those together, you may not need two accountants. You may not need two marketing people. So you can have savings, but the best practices and systems in company A can be deployed in company B and vice versa. So you can often get, if done well, and again, this is definitely by no means a guaranteed, you can get costs go down and revenue go up. So a compounding effect on the profits. Plus, a business that is larger typically sells for a higher multiple. So growth through acquisition, once a company is proven, established, stable, profitable, often the quickest way for growth can be growth through acquiring other companies. So great story on this. Somebody that you would love because he's systems obsessed, is an accountant friend of mine. I haven't asked his permission, so I won't share his name. He wouldn't mind, but just in case he doesn't, his first name is Warren, and I saw him struggle over about 8 years to get his business up to about $2 million in annual revenue, and but the 8 years was miserable. Right, the first 6 years he was barely making any money, and then he finally cracked it and he started to grow. And because his systems were so good, he actually had close to a 50% operating profit margin. And most accountants, it's about half that, 25, 30%. Okay. And I'll be simplistic for purpose of teaching. It's a little more nuanced than this, but most accountancy firms will sell for about 1 to 1.2, 1.3 times its annual recurring revenue, right? So if it's $1 million accountancy practice, it might make $250,000 in profit and it'll sell for $1 million. Okay. However, as soon as Warren acquires that accountancy practice and rolls it in using his existing systems, his margin is closer to 50%. So if he pays $1 million for this accountancy firm, it doesn't take him 4 years to get his money back. It takes him 2 years. And of course, the bigger he's gotten, the more the bank will happily lend him the money. So right. He's able to borrow money at, well, it used to be 3, 4, 5%. It's now more like 6, 7, 8, 9, 10%, right? In today's interest rates. But he can borrow money at that, buy the accountancy firms, and then quickly he scaled rapidly to 8-figure revenues. Right? Because he had the systems in place that create the profitability, but then the strategy for growth was much quicker for him to grow through acquisition. And it's called roll-ups. It's a roll-up strategy, rolling up multiple accountancy firms together, and the sum is greater than the parts. So that's the first 10. The first few are about a good defense. The next 4 are about developing your core business. And the final 3 about being more disruptive.
Interesting. So the risk mitigation, which is the first one, you said can you explain a little bit more how it relates to the multiplier, and what do you mean by the risk mitigation?
Yeah, great question. So I put it this way: it's called net profit for a reason. It's the net of all your wins and all your losses, right? So the question is, what's going to screw this business up? So one example would be, I once had a business that had about 2 million in annual revenue, about 1.6 million annual revenue, but it only had one merchant account. Let me wind back a sec. One category of risk would be single points of failure. 1 is the worst number in business. So single points of failure. So you would say, okay, I had a business with several million in revenue. It had 10, 15 employees, but it only had one merchant account, one way of processing credit cards, of getting money. And the business grew so quickly that the merchant bank wrote us a letter. It was an e-commerce company, and they wrote us a letter. They didn't phone us, they didn't email us, they sent us a damn letter in the post that took a week to get there, saying, we're restricting your merchant account. So you can process customers' credit cards, but we're not going to deposit the money in your bank account because we need to build up a reserve to protect us if you go broke, because of the way the law works in the UK. And I got this letter. They already had £64,000 of my money, right? And this was a small, fast-growing business. How long do you think it took me to get that money back from my bank?
30 days?
I wish. It was 14 months.
Wow.
And they didn't care. Banks don't give a crap. right? They were looking to protect their risk. But you know what? Shame on me, because I didn't have multiple merchant accounts. So they had control over me. And if we'd gone broke and everybody had been let go, right, they wouldn't have cared. They were just protecting themselves. Whereas, so I now got, for all my businesses, they have multiple merchant accounts. And then you don't even have the drama. Said a different way, everyone obsesses about the P&L, but the P&L doesn't show you. Sometimes the biggest wins are losses you avoid, crisis you avoid. How much of your time is spent running around like a headless chicken, putting out fires, right? Rather than just focusing on, by the way, and that's partly what you talk about so often, is about having good systems to make it more replicable and have things go less adrift. But equally, we live in a big wide world, and there's competitors doing things, and there's lawsuits, and there's some things that even good systems you can minimize, but you can't eliminate. Okay, great. Well, one of the ways that you can minimize or eliminate is by having multiple redundancies, right? Like, how many backups of the database do you have? How many people can have the key, can have the route, the documentation? Like, how many people are trained in that role? It's redundancies, because then it's like, okay, wow, our merchant account got shut down, or our bank account got frozen for fraud, or any one of 1,000 things that just happens. Each one might have a small likelihood of happening, but if there's 100 of them and each one's got a 1% chance of happening in any given year, every year you're going to have some mega crisis. But it's very different if you go, oh my God, we've now got no money coming in. Oh, we've got to pay everybody. Oh, we're going to fix it. We're going to open another merchant account. Versus, oh, that's annoying. Okay, just switch it over to merchant account 2 and 3.
Absolutely.
Right? So risk mitigation is what's going to screw this up, and how can I do a pre-mortem? Think about in advance what could go wrong and have the appropriate redundancies in place.
Absolutely. Absolutely. And it's also having good backup documentation, having like everything, all the systems in, or like financial systems under control, not systems, but financial records and everything, like really have, and also have a group of professionals, trusted advisors that work with you, that you trust. In case something happens, you can get them to handle it for you. So absolutely, I agree with you. Dan, this is a fascinating conversation. You are so knowledgeable. And now I think it's very clear to me and the audience of why you are so successful at what you do. You have those systems down, right? You totally do. And as we talked before the show, it's systems and people. It's not just systems. You're looking at the holistic viewpoint of everything. And I so appreciate you being a guest on this podcast and sharing the information. I encourage each and every one of the listeners to actually go to your website and take that assessment so they know where they are at. And I'm already seeing that I'm going to have you as a recurring guest on this podcast, because there is so much more knowledge to share here. But thank you so much for this conversation and for all the knowledge that you shared with us.
Thank you. I've really enjoyed it.
Thanks for listening to the System Simplified podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.